now and hopefully profit from it. So if you're watching this on Twitter, YouTube, Facebook, wherever, welcome. My name's Owen Rask. I'm an analyst and the founder of Rask Australia. So I'm going to explain to you why the stock market has crashed overnight in the United States. And today, the stock market is down 4.4%, which is pretty scary for a lot of folks because this is like a big deal, right? Like we've got tech stocks crashing. I saw before one of my small cap companies was down something like 11% on basically no news. So why is the stock market crashing? Well, basically what we see in most stock market crashes or just before them, we see a lot of investors reeling or taking a backward step when inflation is front and center. So fears that inflation is still rising in the United States and that interest rates may go higher has put more, downward pressure on investors who are scared that the stock market is going to keep falling if inflation goes up and interest rates go up. When I was trolling through overnight all of the different news articles to suggest like a valid reason why the stock market is falling, there was none. So I couldn't find any. And this is so often the case. And I'm about to explain to you why that happens in the stock market and why it happens in financial media. But also the real seems to be like the real catalyst for people is really just about perception. Yesterday or the day before that, the stock market was not worth 5% more or less than it is today. It simply doesn't work that way. But I'm going to explain to you why we get it so wrong once again, and it all comes back to psychology. What's important to recognize, however, is that once the stock market falls a certain percent, the news media will label things like we're officially in bear market or it's a market crash. And typically we say that a market crash is like 20% or more. And that's when we enter a bear market. But again, it's really nothing more than a label. So let me just bring up my screen here. I'm going to introduce the things that you should be paying attention to and the things that you shouldn't be paying attention to. So on this page right here, you can see this is a study, and I've used this quite a few times in our podcasts and presentations. This study here actually shows you, it comes from Charles Schwab, and it actually shows you that if you'd invested $2,000, and sorry about the pixelation, $2,000 a year for 20 years from 1993, I think it was, till 2012, actually shows you the outcome. And here we can see on the left-hand side, if you took your $2,000 every year, invested on the lowest day that year, you would have $87,000. If you just invested it on January 1st that year, you'd have $81,000. If you dollar cost average, so you split up that $2,000 and you put it in over that many months, you'd have 79. And if you had the worst timing, meaning that you invested on the exact worst day for the stock market that year, what would you have? And then if you just kept your money in term deposits, or in the United States, it was treasury bills. This is just if you invested $2,000 into the S&P 500 or an S&P 500 ETF would do the job. But you can see here, and I bring this chart up a lot because it actually shows that even if you had perfect timing, you've got $87,000. But just behind that, it's not that much difference if you just invested the money and just think, well, to heck with it, I'm just going to invest anyway. Or if you just broke it up and invested in even amounts, you're really not that far behind just having the perfect 20/20 hindsight when it comes to stock markets. So the lesson here for people is just don't overthink it. Just invest. Invest for the long term, be diversified, be low cost, and just keep doing your thing. Keep making sure if you're in accumulation phase, keep investing, keep your job, keep earning more, save and invest. The reason why the stock market tends to react really drastically at certain points in time is this thing called recency bias. And here, this is a chart that you can see where I've got green arrows that signify analyst forecasts. And this is, you imagine this is just like a stock, like say Telstra or whatever. But we could also use this for the economy. We could also use this for basically anything that humans forecast. Now, what tends to happen is when things are going really well, like they are up here, human beings tend to take what's happened in the recent past and forecast it out in the future. So this would be like late 2021. Then all of a sudden, oh no, we're in 2022 and the stock market is falling and therefore our forecasts are even more negative. So now we're saying more inflation when a year ago we weren't worried about it. And so this is our recency bias, and the news media loves this because we can just cling on to this and be like, oh, look how bad it is. And everyone's already thinking it. So therefore it must be true. And we see this happen time and time again. You can actually plot analysts or economists forecasts over various things, whether they're commodity prices versus everything. And you can see this sentiment of analysts going more negative when things are negative or more positive when things are more positive. If you're the analyst that's at the top here and you point down, you probably, you might even fear for your job. So recency bias is a big reason why when we're investing, people tend to think things will get worse when they're the worst. And this is why Warren Buffett's quote works, because he says, be fearful when others are greedy and greedy when others are fearful. So you would be fearful up here and greedy down here. That's the whole point of it, right? So the other thing that I'll bring up a bit further is this idea of thinking in habits. Most people, when they plot financial goals, they'll be like, here, plot into the future. My portfolio is going to be worth X dollars in the future. Well, what happens is most people, if they do set such long goals, they minimize the feedback loops in their brain so that they don't actually have daily or weekly rituals where they just keep investing. So if we go back to this chart here, these people just invested immediately, basically, or they had perfect timing in this case. They had the habit down pat of just saving and investing more and more into a diversified portfolio to achieve success. So what I would encourage everyone to do is actually, while we tend to think short term, is actually to build systems and automate our money and our investing in a way that helps us invest for the long term, because that is what compounds. And once you have these feedback loops in place, you'll be much more comfortable to deal with volatility. This is the chart that I was referring to before, and this comes from Morgan House. It's an extract of what he's done. This chart shows you that the most common type of news and information that you encounter is actually emotional clickbait, then gossip, uninformed analysis, and all the way up the end here, extremely rare, we've got news or analysis that requires you to take immediate action on your finances. Jason Zweig says that, and he's a prolific writer, he said, I'm paid to write the same thing every day, 200 different ways every year. And the idea is that good advice and good investing doesn't change. Once you have your investment plans, really everything that happens from day to day is just noise. At least it is. Like, it's very rare that you have to drastically change your financial goals because of some news or analysis. So if we drop down again, I'm going to emphasize once again the importance of long-term investing. And here we can see that over the period from 1871 to 2012, so just a little bit of time, we can see here that Professor Robert Schiller from the United States has calculated the returns from a portfolio, the minimum and maximum. So in any 1 year, the maximum return would be 53% and the maximum negative would be 38%. But if you'd invested for 10 years, like rolling 10-year periods, the best outcome would be 18.3% per year, and the worst would be negative 4.4% per year. So that'd be like if you had a decade of going backwards. And so those would be basically what this chart illustrates is that if you notice the red here, you get less and less red, and the blue comes down, but then it kind of, the longer you invest in a really diversified portfolio, according to this research, the longer that you invest, the more positive your results will skew. Sure, you won't have extreme positives or extreme negatives, but over the ultra long term, the longer you invest, the more positive your returns tend to be. So this would make sense because the stock market, we know, is a place to invest in innovation. It's a place to invest in optimism. So if you are investing over time, the averages will work itself out and you will benefit from long-term value creation. The final thing here is this core and satellite approach. We talk about this a lot at Rask on our podcast, the Australian Investors Podcast and Australian Finance Podcast. But what we can see on this chart here is we can see how we would think about building a diversified portfolio. So here we have fixed interest, we have some emerging markets, and this chart is just an extract. You can find this anywhere on the internet. And then around the outside, we have riskier positions. At the moment, a lot of investors are bracing because tech stocks have been sold down. So they're seeing tech stocks getting smashed. They see really risky things like crypto that really, they're the things that should be out here. Yet investors are taking the signals, as in like the sell-off in these things, so that the whole portfolio is doomed, when that's simply not the case. Right now, yes, maybe bonds or fixed interest have fallen because interest rates have gone up. But in the future, interest rates could come down and bonds would go up. And Australian shares would go up if interest rates came down, and so on and so forth. So, and another positive to take away from this is the cash allocation, that's term deposits and that sort of stuff, is actually paying more in interest now than ever, like it has in the last 10 years, because interest rates have gone up. So there's more to be optimistic about here. And this core and satellite approach, like if we're talking about Aussie shares, that might be something like the Vanguard VAS ETF. You can see it here on our Best ETFs website. And if it's international shares, you might be the IVV ETF. By the way, I don't have a position in these. This live update contains general financial information only. I'm not paid to talk about these things. And the IAF ETF might be one for bonds. So you can see the bond portfolios have come down, paying attention to the axes. It's not as bad as it might look. And so, yes, we've seen some pain recently, but they could just as well go the other way in time. So that's my brief update. 6 reasons to still be positive about the stock market. So here we can see, even if you're perfect, you still don't get that much better results if you just invested. Things tend to look worse, at least forecast-wise, before they get better. Habits trump goals. News, so much of the traditional clickbait designed to make you think and act. A correction, a crash, it doesn't really mean anything. It's just a label. The longer you invest, the more positive your results skew. And a core and satellite approach makes it easy to invest and kind of build an all-weather portfolio, maybe as Ray Dalio would say. So that's my very quick crash course on not worrying about the stock market, setting those long-term goals, keeping it slow, and staying diversified. If you want to get more of this type of content, you can head to Rask Education. There should be a link below, or you can just follow us wherever you get your information. Just remember that this video did contain general financial information only. I do not know what the stock market is going to do in the short term, but over the long term, I am quietly confident that better times lay ahead, not just for investors like me, but for all investors and for our society. So thanks for watching this live update. I hope you enjoyed it. My name's Owen Rask. You can find me on Twitter, on all of the social media channels. So thanks for tuning in. Hope you have a great Tuesday.